Good morning, friends. Welcome to the point. I hope all of you are studying well and are revising the concepts of economy properly video after video. In today's video, we will discuss about a Laffer curve, which describes the relationship between the tax rates of the government and the revenue collection by it. So I know that tax is an important source of income, be it the government of any country, because a lot of things depends upon how much tax is collected in a year. The welfare schemes, the development, the infrastructure all depends upon the tax that is collected as a source of revenue. So what this Laffer curve says that, for an example, if there is a sugar producing factory in a country, okay, now this and the MRP of 1 kg sugar is 100 and the tax levied on this sugar is 10%. okay, now after a point of time the government thinks that it needs to increase its revenue collection, so it increases the tax rate that is levied on this 100 rupees sugar. So earlier where the tax collection was rupees 10, because 10% of 100 is rupees 10. Later when the tax rate is increased by the government, so 20% of 100 is 20 rupees. Later on the government again decides to increase the tax rate by 10% again, and now the effective tax rate is 30% on this 100. So now the tax rate stands at 30 rupees. So if you see, the tax collection of the government is gradually increasing, but at the same time the cost of the sugar, which was earlier available for 100, now is available for 130. So initially when the tax rate changed from 10 to rupees 20, that is the cost change from 100 rupees per kg to 120, it did not bother the consumer much. But when the rates of the sugar increased from 100 to 130, then it is a matter of concern for every customer or the consumer of sugar, and definitely that consumer will look for an alternative of sugar. So it could be stevia that is consumed, or it could be honey. So every customer would want to change the source of sweetening the food, and would definitely shift to another product, and would stop altogether the consumption of sugar. So what will happen? So the government initially thought that if we will increase the tax rate, there will be increase in the tax revenue, but after a point of time, if the government keeps on increasing the tax revenue, they will lose the tax revenue altogether. Why? Because the customer will altogether stop consuming the sugar, or the sugar manufacturer would be demotivated to produce the sugar because of the increase in tax rate. So this is what the Laffer curve says, that if the tax rates are increased above a certain level, the tax revenues can actually fall, because the higher tax rate discourages the people from working or consuming the good which they were consuming earlier. The curve was developed by an economist called Arthur Laffer to show the relationship between the tax rate and the amount of tax revenue collected by the government. So what does this curve represent? A relationship between the tax rate and the amount of tax collected by the government. That is what I explained to you, that initially definitely the tax revenue will increase for the government, but in the long run they will reduce, or it will reduce to a very good extent, and the vice versa happens, and we will in the next slide. So the Laffer curve can be divided into two parts, short-term effect and the long-term effect. In the short-term effect, if you see, definitely the tax revenue will increase as it was increasing, but in the long run, if you see, the government may end up losing the entire tax revenue, as the customers will shift to the alternate product. Same way, if we see, if the government decreases the tax rate, so in the short run the tax collection would definitely decrease. Why? Because they have all of a sudden cut the tax rates. But in the long run, if you see that, which is called the economic effect of tax cut, the government would certainly witness increase in the tax revenue collection. How? So let's suppose if after this was the disposable income. After the tax was paid at the rate rupee 1, 9 rupees was left with the citizen to spend in the market. Okay, now if the tax rate is cut by $1, or let's say 0.5%, now after 0.5%, the amount which is left with the customer is, or the person, is 9.5. Now this additional 0.5 will be definitely spent by the customer in the market to buy certain extra products, or it can be used to make some investment as well. So now when the customer is buying the extra product from this 0.5 rupees in the market, it is again creating a source of revenue, because when this 0.5 is again spent in the market, definitely a customer has to pay tax on the goods purchase. So what it is having, so what effect it is having in the long term, that it is increasing the tax revenue for the government. So in short run, the tax revenue would decrease, that is for sure, but in the long run, which is called the economic effect, the tax revenue would certainly increase, as the additional income that is left, or the additional amount that is left with the customer, would be again spent in the market to buy the extra products. Now, understand this through a graph. So on the x-axis it is the tax rate, and the y it is tax revenue. So if you see, initially if the tax has increased, so earlier when the rate was 15%, so this much was the tax revenue or the tax collection of the government. Then the government increased this tax rate from 15 to 50%. So it is a very good indication for the government that the tax revenue is has increased from this to this, right? Now if you see, there is a point that is the maximum. If the government increased the tax rate beyond this 54%, it would witness decline in the tax revenue collection, as that has happened in this case. Now if you see here, that after 54%, if the government has increased the tax, it is causing the downward slope, which means that this was the maximum revenue that the government can collect if it increased the tax rate. Now if you see, now at the rate 85%, how much is the tax revenue? It is this much, the dotted line. Okay, now if you see how much is the tax collected, there is a fall in the tax revenue from here, which was the maximum. If you see, there's a downward shift in the tax revenue. So that is what Laffer curve is trying to explain, that if you increase the tax base, or sorry, the tax rates after a certain limit, then it would lead reduction in the tax revenue which initially increased. So friends, I hope the relationship between the tax rate and the tax revenue collection is being clear to you with the help of the diagram, that is this graph, as well as the example which I have given you in the previous slides. So friends, this is all for the today's video, and thank you so much for your patience listening.